Okay, so now we are going into understanding each of the standards. A detailed video of this I've already covered, but here we'll touch upon the few essentials of all the standards. There are 7 standards of professional conduct, starting with professionalism. And within that, there are a couple of standards. Overall, there are 22 substandards. Many students ask me, do I need to memorize all of them? Do I need to know the names of all of them? To be very honest enough, I memorized it. Why? Because this has the highest weightage. So no harm in it. You have to give enough amount of time in doing ethics. And see, gradually, if you are going to read it and do a lot of questions, you won't need to memorize. So this question, which I every time get it, that should I memorize this? Should I memorize this? I cannot understand it. Should I memorize it? See, if you practice something regularly, you don't need to memorize it. Okay. Especially in ethics, there is no formula. So there's no need to memorize it. If you're going to read it again and again, you'll automatically remember. Okay. So now we'll move into this standards of professional conduct one by one. I have put the detailed notes here. I've just summarized everything. So if you see in my revision book, all the other books I've shortened the content so that you only focus on what is essential. When it came to ethics, my actual notes and my revision notes, they both are same, because I have not cut down anything on ethics, because I want when you revise ethics also, at that time also, you read the same level of content. However, many people would want to flip it fast, so I've bolded those important keywords here, right? So I suggest you to, if possible, when you will read again and again, this couple of 10-15 pages, it's not more than 10-15 pages ethics. So that is, I think, that is what ethics deserves. This much amount of hard work in terms of memorizing the content of codes, that is absolutely okay. Everyone does it, and you should also do it, right? So now, yes, first standard, professionalism. Under professionalism, there is knowledge of law. Okay. Now, I'll tell you the theme of this particular standard. There are in this first itself, there are 4 substandards. Number 1 is knowledge of law. The theme of this standard is that as a CFA, first of all, when we are talking about these standards, who should follow? Everyone who's in the investment industry, right? Your knowledge of law means when you're managing money for your clients, you need to have knowledge of all the applicable laws, rules, and regulations that is going to be affecting your clients' investments. You cannot say that I was not aware about this particular law. Basic thing, don't violate any laws, rules, or regulation, whichever country your investment belongs to, or even any other country, by the way. And any violations of code and standards also is considered a violation of this subsection. So basically, you violate any law, that is also the violation of this standards automatically. Now, whenever you are confused between managing multiple assets in multiple legislation, always follow the one which is the strictest of all the laws. So, for example, you are managing money for a client who is based in country A, you live in country B, and your firm is in country C, and then you have CFA Institute standards. If they all say differently, follow the one which is the most strictest of all. Okay. Here, it is strongly encouraged for members and candidates to report the violations if you come across anyone doing it. Remember, the key is you are encouraged. You are not forced to do it. So look out for this word: encouraged, recommended, required, all mean different things. Okay. Complain, disassociate, or resign in extreme cases. So see the step. First, complain, try to disassociate with that illegal activity whatsoever. And in the extreme case, resign from that particular job. Okay, step by step. Clear? You don't have to directly resign. Now, what are the recommendations for members and firms? That is a theme in all the standards here. For members, they need to consult someone in case if they are confused or they are not clear about the law. You can consult your supervisor, immediate supervisor. Every company has a compliance officer. You can consult to them, or you can have an independent lawyer's consultancy. In cases where you have to disassociate it because there was a violation, you are required or encouraged. You are required or encouraged. Well, look out for the keyword. You are encouraged. You encourage your employer to bring an end to the violation. So you're not required. You have to encourage. But one thing which you have to do is that You have to keep record of the documentation of the violation. Means the violation that you have seen and you're trying to disassociate from, you need to document that. Okay, so tomorrow if the claim comes, you can say that this is the violation and this is the reason why I disassociated. Okay. Is there a requirement to report any violation to the legal authorities? Well, not so. So no requirement in the standards to report the wrongdoers, but if the local law requires it, only then you can. And that too, they have used the word members are strongly encouraged. First of all, am I required to report the violations to anyone? No. But if the local law says you should, then you should. No if and but there. However, when it comes to CFA Institute, they have their professional conduct program, which we just learned, right? Their internal law. Under that, if they ask us, then we are strongly encouraged. Again, we are not required, but strongly encouraged. Understood where it is required, where it is not required, where it is encouraged. Very important. So basically, what is the theme of the first law? Knowledge of law. You should need to follow all the law, correct? You should have the knowledge of all the laws and regulations applicable, and you need to follow it. What is more important from the exam is that they ask you this thing, that if you come across any violation, are you required or encouraged to report, etc. Now, for the firm also, there are some recommendation. Every firm needs to have their internal code of ethics, which many of them have under the corporate governance. And they should provide this information with their employees or with all the people associated as to what is the law and regulation associated, and have procedures for everyone to follow if they come across any violation, right? The second standard 1B is about independence and objectivity. I call this standard as the standard of gift, right? First of all, member and candidate, you should use reasonable care and judgment. Means they should maintain independence and objectivity in the sense that they should not let their independent decision making ability to compromise. So members and candidate must not offer, solicit, or accept any gift, benefit, or compensation or any consideration, whether cash or in kind, that can be affecting your decision, that could be expected to compromise their independence. So I should not take gift from someone because of which I might compromise my service. That is not allowed. Members should not let their analysis get influenced by the pressure or in documentation of, otherwise it's a violation. In the sense, you should not be pressured or induced by someone, right? So if you're making a research report and someone is offering you something to write a better research report, that's a violation of independence and objectivity. Allocating shares in oversubscribed IPO. When an IPO is already oversubscribed, allocating shares to yourself rather than client is a pure violation. This you will see repeated across. Now, why do I call this standard as a standard of gift? Your client, if the client gifts you, you need to disclose that to whom? To the members' employers, but highlight this, prior to the acceptance if possible. So gifts need to be, are they requiring us to take the permission? No, you need to disclose it prior to acceptance, which indirectly means a permission only, right? Correct. But still, you are not required to ask a permission. You are required to disclose that to your employer before accepting it. For the members, it is always recommended that members, when they're going for business travel, they should not take a private jet. Okay, they should take the common affordable or common transport, unless and until it's in a very remote area where there is no other option. Only then you can take some special benefit. Otherwise, you should follow what everyone does. You should not take any undue favors. There are many questions that you will come across on this. All right, clear? Many questions you will see about this corporate aircraft trips and all. For the firms, they should restrict the employee participation in IPO. They should have the standard policy. And for employees, because they're confused as to what they can do and not, firms are requested, or they should appoint, not should, basically they are recommended to appoint a compliance officer and have written policies on independence and objective and clear procedures for any violations. Also, as I said, this standard is about gift. So you should limit the gifts other than from clients to token items. So many of my friends also who work in various sort of investment advisory and consulting or management, in that the companies have decided as to what is the allowable gift. Many companies have this, let's say $100 or $1,000 is the maximum gift that you can accept, otherwise you cannot. So many of the companies have the policy. Okay, if not, they are recommended to have. So professionalism, correct? Under professionalism, number one, knowledge of law. Second, independence and objectivity. Third, misrepresentation. Misrepresentation is common in the sales, right? Means you should not knowingly misrepresent anything, knowingly mislead the investors or omit some vital information. And those who selectively present a data, that is also a violation. Plagiarism. What is plagiarism? Plagiarism is when you're using someone else's models, charts, or data without crediting the source. Using someone else's information without crediting the source, that is plagiarism. It's a violation of this standard 1C of misrepresentation. Credit source is not required if you're taking from open platform or open statistics, like you're taking central bank's data or you're taking data from the paid services. Then in that case, the credit source is not required, right? When using projection statistics tables from recognized financial and statistical reporting services. For example, I'm using Bloomberg. In that case, I don't have to every time write that this data is from Bloomberg and all. No, it's not required if you're using projections from this financial intermediaries. But when you're using models developed or research done by other members of the firm, it is permitted to omit their name if they've left the organization, but then you cannot say this is the work only done by you. So you cannot represent that this work is only done by you. You can omit the names who are no more with the companies, right? But you cannot claim solely the model is done by you, right? Actions that would cause violate of this standard of misrepresentation is when you're using third-party research and cite it as your own. That is also wrong. Using the word guarantee is a taboo, except you are investing in US Treasury securities. Otherwise, you cannot use the word that we guarantee the returns. And selective performance, also, putting up a performance and comparing it with a benchmark which is not suitable, even that is wrong. Okay, so a non-comparable benchmark, that is also misrepresented. Presenting performance data that omits accounts, we've already discussed. Offering false or misleading information about analyst firms or capabilities or any expertise, means exaggerating the firm's abilities, even that is misrepresentation. And using marketing materials of third party, but you're not verifying it. And if these ads are misleading, then again, it's your responsibility. So if you're using someone else's misleading material, even that's a violation. Okay, so we are under misrepresentation. What are the recommendations for members? Members should prepare the summary of what experience, qualification, and services that their firm is providing, so that you are clear as to what to communicate. You should encourage your employers to have procedures for verifying the marketing materials like brochures and emails, whatever is being marketed, especially those which are provided by third parties, because you are relying on them. Correct? So nothing should be exaggerated here. Cite the source of any summaries of materials provided by others. Always give the credit, right? And keep the copies of all the reports and materials that you are using in terms of research reports, so that tomorrow if a claim comes that you're misrepresenting the data, you have the documentation. Also, as I said, all the available services and qualifications of the people in your team, that should be available to the client whenever they request. Periodically review these documents and communications of members for any misrepresentation by employees. So regular documentation is needed as for members' communication with the clients, so that we can identify if any misrepresentation is done. This is standard 1C, misrepresentation. 1.4 is misconduct. Misconduct is basically you are engaging in any professional conduct which relates to dishonesty, fraud, cheat, etc. And this need not be only related to your job, but it can be outside the job also, because it reflects adversely on the professional reputation and integrity of the client, of the member, right? Member must not try to use enforcement of this standard against settling personal or political goals. Yes, many people, because they are CF Institute members and they come across another CF Institute member and they want to just, score some personal goals, and they might complain about them just because they had a dispute. Even that's a violation. You cannot misuse your power here. So the intention being dishonest is what is a concern here. Okay. Recommendations for the firms to avoid misconduct is that develop and adopt a code of ethics to make clear what is unethical behavior or unacceptable behavior, right? And what will the firm do? Why will it not tolerate? What is the punishment for it? Basically, give employees a list of violations and sanctions, including dismissal, right? And check references when you hire people. That is very essential, and many companies do that. Okay. This is standard one, professionalism. Okay. Under professionalism, we discuss knowledge of the law. Second, independence and objectivity. Third, misrepresentation. And fourth is misconduct. Clear? Right? The second standard is about integrity of capital markets. This is all related to the overall market. And here comes one of my favorite standard, material non-public information. Material means any information which will affect the price of the security. Non-public means something that has not been made public yet. Correct? However, if you're doing your detailed research of all the perspective, you're taking information which is public information or non-material, then that is not called insider trading or material non-public. Then that is called mosaic theory. Mosaic theory means you're gathering all the public information, or you're taking non-public information, but that is non-material, right? Combining all of them together and then framing a research is called mosaic theory. This is what research analysts do, right? But if the information is material and non-public together, then it is violation. So when companies today, investment banks are doing multiple businesses, right? So they have different departments. Any person moving from one to another department can be privy to such an information. That's why many of these firms have firewall. So one person cannot go to that department which has this vital information. That is called firewall. Review employee trades to check if they are trading on material non-public information, and maintain a watch, restricted or rumor list, especially when the company is working on that stock. For example, if your company is working on an M&A deal, mergers and acquisition deal, then you probably need to make a list as to a restriction list so that people don't trade in it. Monitor and restrict proprietary trading, especially when you have that information. No one in the company should be trading on that, right? But there is a problem here. When you prohibit everyone to trade on a specific security, people indirectly get an idea that why are they putting a restriction? Do they have some vital information? So you have to be very careful that, if you put a restriction completely, people will probably get tempted that there is something, important information is being possessed. So that might give signal to the internal as well as external people. And therefore, companies should be very careful with that. And they should only take opposite side of such trades. They should not participate in the same trades, right? On the same side, they should take the opposite trades. Second is market manipulation. This is material non-public information. Remember, your mosaic theory is very crucial and very much asked. Okay. Market manipulation is that the company or individual should not engage in any activity that will artificially inflate the price of the stock. Okay. Price or volume, anything. However, members' actions may affect security values and trading values without violating. Yes. So in US, there is a term called specialists. The specialists provide liquidity, right? And their job is to provide liquidity, especially in the time of IPO. So they buy, sell to create liquidity. Now, that's not manipulating the market. That's providing liquidity. So that is allowed. Okay. But manipulating the markets, artificially inflating, that is, of course, a violation. The key point here is that if there is an intent to mislead, then the standard is violated, like spreading false information to affect the prices. Most of the stock market scams of rigging the prices are due to market manipulation. So standard 2A, material non-public information, standard 2B, market manipulation, right? Now we will understand the biggest of all the standard, that is duties to clients. First of all, just I will note down here for your reference. Professionalism has 4 substandards, right? Integrity to capital market has 2 substandards. And the third, duties to client, is the biggest. 5 substandards you have. Duties towards clients, right? First, the most famous is loyalty, prudence, and care. And after client comes duties to employers. Even that has the first standard, loyalty. Loyalty means members must act with reasonable care and prudent judgment. That's same like 2B, independence and objectivity. But you should be careful even if the client doesn't say so. Number one thing that you always need to remember, that the client comes first. So the priority is client, then employer, and then your personal interest. Client, employer, and then personal interest. Do not discriminate against various clients. Understood? Especially when you're giving up recommendation or information. Everyone should get the, everyone should be able to get the information together. You should not be biased in terms of giving information to some clients at the cost of other. Members and candidates may make investment decision in the context of total portfolio. You should always look from the total portfolio point of view. Inform clients of any limitations in your advisory service. We are not God. We cannot promise them moon. So whatever we cannot achieve, we need to inform the clients of whatever, mistakes we can make, or whatever products that we recommend, they can turn bad. We need to inform that to our clients. We have responsibility to vote proxies on behalf of the client. So we need to do that in a responsible manner, taking into consideration the fiduciary responsibilities towards the client, not towards the management. Now, very important thing is the concept of soft dollars. Client brokerage or soft dollars must be used to the benefit of client only. What is soft dollars? Soft dollars, see, suppose because I'm an investment management firm, I get clients millions of dollars of funds. This millions of dollars of fund I put to trade. So wherever I am putting for trade, I'm paying them brokerage, right? So that firm is earning from me in regards to brokerage. In return, the firm is giving me some special services, probably for free or at discounting rate. Like they're giving me subscription of the magazines, or they're giving me access to important data. All this, I cannot use it for my personal benefit. I have to use it for the client, because this benefit I got is due to the trades that I put for the client. This is called soft dollars. Okay, sometimes I might get discount in the brokerage. All of this, I need to use it for the client only. I cannot use it for another client or someone else's benefit at my company. I should use it exclusively for those clients, right? Very important is the first thing now. Recommendation for members: submit to clients at least quarterly itemized statement. Now, like this, there are total 4 or 5. As far as I remember, 5. In fact, 4th and 5 are same. So total 5 places where there is a number. So itemized statement, itemized, by the way, we are under loyalty, prudence, and care. Itemized statement to the client should be submitted at least quarterly. You can write it one, I write it Y1 or K1, whatever you want. You can write your initial and write 1. Your initial and 1. So this way, there are 4 or 5 places where there is number. I've highlighted them in the blue, right, for your reference. So your eyes should be on that, because they have highest chances of being asked. So even if the client doesn't say, you need to at least give them quarterly, right? Encourage firms to address these topics when drafting the policies and procedure regarding fiduciary duty. Remember, you have a fiduciary duty, means you have a moral obligation. So follow all the applicable laws and rule, establish investment objective of the client, right? That's why we have IPS, right? Consider suitability of portfolio to the client's need and circumstances, means give clients only those, asset allocation should be done in the manner that is suitable to the client's needs, objectives, risk and return constraints and everything, right? Seek best execution, means try to reduce the client's cost when you're doing best execution. But that doesn't mean you always buy the cheapest. buy the one, or you, when you do take a buy or sell decision, see to it that it is the best decision, right? Best execution, correct? All of these are encouraged for the firms. These are recommendation for the members. Members have to report to their clients at least quarterly, itemized statement. All of this is under loyalty, prudence, and care, correct? Soft dollars, reporting quarterly, right? These are some of the things that they ask frequently. This is loyalty, prudence, care, standard 3A under, we are under duties towards clients, right? Now, the second is fair dealing. This is very interesting. Fair doesn't mean equal, means it doesn't mean that everyone should be treated in the same manner. People take different services, so everyone might be getting different services. What is itemized statement? See, itemized statement is detailed statement of all the buying, selling done for the client, correct? Not just the portfolio value, all the portfolios, what has been the buy, sell during the period, what has been the brokerage, what has been the returns, all that detailed statement is called itemized statement. Understood? Correct? In the company where I used to work, we used to do that on a monthly basis. So that's a detailed bank, like a bank statement. Here, it's an investment statement. Okay. Fair dealing. Fair means you should deal fairly with all the clients, fairly and objectively. You should not be biased in dealing with the clients. But here, fair does not mean equally, right? Some clients have paid extra amount for some special services. So there will be differences in services, especially in the time of communication, the mode of communication, right? But the basic communication to all should go simultaneously. Detailed communication or detailed levels of services can be, first, are they allowed? Yes, they are allowed, but they should not be at a disadvantage to any other client. For example, if I think that, we've come across with a new recommendation that we need to sell this stock. So the basic communication, I will disseminate to everyone together. Maybe on an email, I'll send it to all. Then I might call to those clients which are high net worth individuals or who have taken special services. For them, we might call and explain them in more detail, or those who are going to be affected with the position, we might do them call on a priority. So that doesn't mean you're dealing unfair. However, this special services should be disclosed to all, and anyone who can afford it or who can pay it, they should be available to all who are willing to pay and get it. Here I give a very nice example that fair dealing does not mean that even if you have bought an economy class ticket, you will get a business class seat, right? So people who pay, they might get a priority in services, but it's open for all. It's not only open for a class of people, it's open for all. Anyone who wants to pay and get it, they can get it. That is called fair dealing. Clear? So how to treat with different clients? As I said, there should be a fair opportunity to act, give all clients basic information, as I said, right? In fact, those clients who are not aware of what a change, and if they ask you to buy or sell a security, which your advice is against it, you need to step in and inform the client before placing that order. You cannot blindly say, you said, so I did it. You need to tell the client that, sir, are you aware that we have a sell recommendation on this stock? If not, I would write to advise you. Then let the client take a call. Correct? Members should not take advantage of their position in an industry to disadvantage the clients. Therefore, strictly violation is that you cannot participate as a member in an oversubscribed IPO because client is number one. Okay. Here, for the member, the recommendation is to establish compliance procedures in your organization to disseminate investment recommendations. So how the investment information will be delivered to the client, for that there should be a procedure so that no one is left out. And maintain a list of client holdings so that these people who are going to be affected the most, these people are informed also, and you are not left out with them, and you might probably have to call them and inform in detail. Correct? Here, there are more recommendations for the firm. Firm should limit the number of people having access to this information. Otherwise, it will probably, the information will spread out. It will become a material non-public information if the information is crucial. And why should you limit the number of people who are aware about the changes and recommendation? So that it can shorten the time frame, so that it can be quickly disseminated. Otherwise, many people having the information might dilute the information. So limiting the people having that information about the change and disseminating in the quickest time is recommended. Disseminated means distribute basically. Publish personal guidelines for pre-dissemination, have in place guidelines. So what should I do when we have to give information to the clients? We have to deal with the clients. In that, there should be a proper guidelines. Disseminate new or change recommendation, as I said, simultaneously to all the clients who have expressed an interest. Understood? Or for whom the investment is suitable. This should be done. The basic information for all should be going together. Develop a trade allocation policy, ensure fairness to clients and timely and efficient execution. All of this you can read. Disclose trade allocation procedure, especially during the IPO. And that's why I said most of the companies don't allow people to participate in the IPO, the company's employees. Understood? You should do an account review to ensure that no client is given a preferential treatment when they shouldn't. And therefore, you should disclose all the levels of service so that anyone, you should mention it to the client that these are our level of services. If you want a priority, you can choose these services, right? But as I said, it should not be at the cost of other clients. This is my standard 3B. 3B is about fair dealing. 3C is suitability. Suitability, this standard has everything to do with IPS. See, in the IPS investment policy statement, that's why we are doing it after portfolio. The client has told that what is my risk return objective and everything, whether I can use leverage or not, whether I want my investment manager to follow ESG, etc. All this information the client has mentioned. So when we are in the advisory relationship, we must gather all this client information and act accordingly. Here, very, very important that they ask is unsolicited trade request. See, sometimes, the client will ask you to do a trade which is not suitable. In this case, our job is to not blindly take the trade. We need to discuss with the client whether the client, first of all, we need to check whether it is suitable. If not, we need to discuss with the client before taking such a trade. Why? Because it is unsuitable as per the IPS that you and the client has decided. Correct? Here, there are some steps. If the trade has a minimal effect, right, then manager should follow the company's policy, which is regarding to unsuitable trades. Companies might have a policy as to what should they do. Most of the times, the companies have policy to get an email or something like that. However, if the impact is big, material, correct? In this case, it might affect the client's overall objective, right? Therefore, here the manager will number one request the client that, sir, do one thing. First, let's update the IPS. So tomorrow you are okay with, I making such a big change. So number one is that update the IPS risk return, correct? Here, sometimes the client might agree, sometimes the client might not agree. If the client will not accept to change the IPS, right, then I cannot take such a trade. Then I need to follow the firm's policy, which may allow the trade to be made in a separately directed account. So tomorrow, if the client tells me, why did you do the trade? If the client, backtracks, then I can say, sir, we have done it separately because it was not suiting to the IPS and you are not ready to update the IPS, right? But what if there is no such provision of separately managed client account? In absence of such a thing, the manager may need to reconsider whether to maintain the relationship with the client, because you cannot take a trade which is unsuitable to the client as per the IPS. Tomorrow, the client can claim that you did not follow the IPS. So it's better you not take the trade unless the client is ready to update the IPS. Got it? So what are the recommendations for the member here under standard 3C suitability? For each client, put the needs, circumstances, and all the details documented in the IPS and review it periodically, because client circumstances might change or the market conditions might change. Got it? Standard 3D performance presentation has a very good connection with GIPS, especially when it will talk about components. So first of all, this is a very crucial thing, because when you present information or performance to the clients, many people do selective performance. So while communicating the performance presentation with the client, members and candidates must make reasonable effort to again ensure it is fair, accurate, and complete. You should not misstate any performance or mislead. You should not misrepresent past performance and commit that in the future the returns will be higher. You cannot do that. Of course, it doesn't mean that you always give a detailed performance presentation. You can give it in a brief, but if the client asks for detail, then you can probably disclose it. Okay. Here, the recommendation is to, for the members are strongly encouraged, you can say, to adhere to GIPS, Global Investment Performance Standard of the CFA Institute, where they have standardized the performance measurement. Okay. So they strongly recommend to this. Consider sophistication of the audience. You cannot present the report in a complicated manner. You have to see who the client is and accordingly. So for example, this is a very common thing that I mentioned in the class. You cannot tell the client that, sir, the downside deviation is this, the drawdown is this, the VAR is this. Many clients won't understand. So you need to explain what is this parameter about. Okay, what does this statistic mean? Present the performance of a weighted composite of similar portfolios rather than performance of a single account. Now, this is what we are going to discuss in GIPS also. What is a component, or what is a weighted composite? So if you go and flip few pages, we'll go into GIPS. So in GIPS, I've mentioned here what is composite. I think in page number 114. You can come on this page and discuss what is a composite. First, let us discuss what is a composite and then we'll go back. Composite is a grouping of individual discretionary portfolios, discretionary where the management has full control. These all have similar strategy objective, correct? Or a similar mandate. Examples are large cap growth stocks, means all the large cap growth stocks will be under one portfolio or under one bucket. That is called composite. So for client A, B, C, all of the performance of all the large cap growth will be under one composite. What should the composite include? A composite such as international equities must include all fee-paying discretionary portfolios that the firm has managed in accordance with the particular strategy. So all the international equities and which portfolio? Fee-paying, right? Some are your internal portfolio is not that. All fee-paying discretionary. Discretionary means the entire discretion is with the manager, not with the client, correct? All of that should be under one group, that is composite. The firm should identify which composite each managed portfolio should be included, but before the performance is known. You cannot selectively add them after the performance is known, right? You should prepare this composite before the performance is out. This prevents from selectively choosing in the composite the superior return funds, right? So composite basically is a group of different portfolios having same strategy or same mandate. Clear? Understood? This is composite. Again, we are under standard 3D. 3D is related to what? Performance presentation. So let me go to 3D again. 3D performance presentation. So when we were discussing about composite is those portfolios with a similar strategy, right? Include terminated accounts so that there is no survivorship bias. Include all disclosures to fully explain the results. And sometimes the client might need more detailed information, so you can present model results included gross or net of fees. So yes, when you present performance, you should tell the client whether this is gross or net, pre-tax, post-tax, before fees, after fees, etc. Maintain data and records to calculate the performance being presented. So whatever performance you're presenting, sometimes the spreadsheet and everything, that data you need to present in case if the client asks, you can provide. This is standard 3D. Okay. Now, 3E is preservation of confidentiality. Yes, client information is crucial. You cannot just disclose it. Here, one very interesting thing I'll discuss. Standard 3E, members and candidate must keep the information about current format and even prospective clients completely confidential unless it is illegal unless the information concerns some illegal activities on the part of client and the law requires you to disclose it. In that case, you cannot say it is confidential. Okay. But see, sometimes the law says that confidentiality is important even it is illegal. For example, if your money is in Swiss bank, so Swiss bank says, we don't care where the monies come from. You cannot reveal the client information. Then We have to follow the stricter law. Understood? The client or prospective clients permits to disclose, then you can disclose such an information. The confidentiality also extends to former clients. If illegal activities by clients are involved, members may have an obligation to report to the local authorities. As I said, that depends on the local laws. But sometimes the CFA institute might also want to conduct an inquiry, right? So see, very interesting. The requirement of these standards are not intended to prevent members and candidates to cooperate with the CFA PCP when they want to conduct an inquiry. So they are not intended to prevent, but they also don't give you the permission to do so. If the local law says no, then you cannot share with CFA institute also. Clear? So client confidentiality is paramount. What are the recommendations for members? Members should avoid disclosing information received from a client except to those who are working on the project, authorized co-workers, for those who are working for the same client. Members should follow firm's procedure for storage of data and recommend adoption of such policies if they are not in place, so that the data is not lost, the confidentiality is not lost. However, storaging of data is the job of the firm, not the member. Correct? But members should recommend the firm to have enough provision for storage. So this is standard 3E, preservation of confidentiality. We are under standard 3A, loyalty, prudence and care. 3B, fair dealing. 3C is about suitability. 3D is performance presentation. And 3E is preservation of confidentiality. This was the biggest of all the standards. Correct? Now we will discuss duties to employers. Duties to employers has 3 substandards. Loyalty, then duties to employers, similar to duties to clients. Client had loyalty, prudence and care. Here you have loyalty. Additional compensation arrangement. And third is responsibility as a supervisor. Yes. Now under the loyalty, you see many things I have mentioned. Again, the number one priority is still the client. Then comes employer and then comes your personal benefit. So here in the matter of choosing all, of course, number one is employer, client, and then comes employer, right? But now even if client is the number one priority, members should not do anything against the employer, should not deprive their employer of any undue advantage of their skill or abilities, or not diverge or dilute any information about the employer, right? That's a gross violation. There is no requirement that employee put employer's personal interest ahead of family and other obligations. Means there is no requirement that the employee put employer's personal interest, employer's interest ahead of personal and family. Means, see, employer is a priority, but not at the cost of my family or any other personal obligations that I have. Not personal interest, but any personal obligations. Correct? It is expected that employers and employees will discuss such matters and then they will resolve it. So basically, whenever you have a conflict between choosing something which is very utmost necessary and which is personal, and then there is employer's condition also on the other end, then you can negotiate, you can basically discuss with the employer. Those who are doing an independent practice, okay, for them, for compensation is allowed if a notification is provided to the employer fully disclosing all aspects of the service. So for example, I'm working with the firm and I have an independent practice also. I'm consulting on the weekends. Now, this might be allowed, but I have to provide this information to my employer in full detail as to if there is any compensation. Compensation can be in cash or in kind or any form, right? I need to tell them how much time I'm going to spend there, what is my commitment there, everything. And employers consent to all terms of the proposed independence practice before it begins. You have to take your employer's consent before taking such activity. Understood? Clear? Yes. So if you're doing some independent practice, apart from your job, you need to take the employer's consent. Very, very, very frequently asked is that what should the employee do when leaving the firm? What is violation and what is not a violation? So while you're leaving the firm's, the current employer, what will constitute a violation and what might not constitute a violation? So first of all, what is going to be a violation? Misappropriation of trade secrets of your employer, misusing any confidential information about them, soliciting employers' clients before leaving. Before leaving is a violation. After leaving is not. Self-dealing, dealing for your personal gains is a violation. Misappropriation of client list or taking away any records of the employers, right? Wherever it is in digital form, stored with you or in documents, that is a violation. But while leaving the firm, what is not a violation? See, simple knowledge of my client's name or any existing thing is not confidential. That is whatever knowledge I have about my client's name, existence, that is, if that I take away with me, that is not a violation. Okay. You cannot take away the documents, the knowledge you can, right? There is no prohibition on the use of experience and knowledge that you gained at your employer. Whatever you learned it, you can utilize it. If an agreement exists among employers, for example, in US, all the brokers, they have this condition called US protocol for broker recruitment. Under this thing, the brokers are allowed when they move from one to another, right? So they can take away their client's data. That is allowed under the US protocol, one of the protocols. So in that case, you can take away, otherwise you cannot, right? Clear? Now, one more thing I wanted to say here, that you might have seen many of the questions where they say that, can I prepare for joining another company, like giving interviews and all while I'm still at work? Well, you can prepare or not. As per the ethics, of course, we all do it, but I'm just saying, can I prepare for my new business? Let's say, while I was working in the organization, I had resigned, and then I was, I was trying to register my company. But before I left the company, can I do that? Yes, preparing for the next job or next business while you're still at work, you can do it. That's not a violation. Got it? Right? That is not a violation. Recommendation for members. Members and candidates must adhere to their employer's policy, especially with regards to social media. You cannot blast your employer, services and everything on the social media. It is therefore recommended for you to have a separate social media for personal and professional. Members are encouraged to give their employer a copy of what is codes and standard with regards to this. For the firms, employers should not have an incentive or compensation that will encourage members to be unethical. You cannot incentivize them for this, right? This is number one condition, duties to employers, 4A, right? Loyalty. Under duties to employers, loyalty. The second is additional compensation arrangement. Additional compensation. This is very, very crucial because it has a relation with the standard 1B, which was related to gift. 1B talked about gift, and this 4B talks about additional compensation. How are both different? So here also it talks members and candidates must not accept gift, benefits, or compensation that competes with or might reasonably expect to create a conflict of interest with the employer's interest. Okay, so here it is not talking about the gifts that you get from your client, right? Here it is talking about the gifts that you get to, which is in competition with your employer. Now, this compensation can be direct or indirect compensation from the client and other benefits received from third parties. Now, what is the difference here? See, additional compensation, for example, if in client industry, if my client tells me that, Kunal, if you generate high performance in my fund, I will give you compensation extra. That is additional compensation. It is for future performance. Gift, you did a great job, so I want to gift you. So gift is generally for past performance. Now, what is the rule? I've summarized it. If there is additional compensation, it is going to compromise your employer services. So in that case, you require written consent in advance. But in terms of gift, there was no written consent required. You had to disclose to the members' employers under the gift. So gift, that is standard 1B, you have to disclose. Additional compensation, you have to take written consent. Of course, before taking it. Understood? That's the biggest difference here and compared to 1B. Many student gets confused that, What is additional compensation? This is also gift. 1B is also gift, right? No, additional compensation is for future performance. Gift is for past performance. Clear? Members are recommended to make immediate written report to employer detailing any proposed compensation or service that you are being offered or you are going to get. In this case, you have to write it in report, write a report to the employer, right? If additional, if additional to that provided by the employer. So we should immediately give a written report to our employer. Members and candidates who are hired to work part-time. Do the part-time guys also have this on their shoulder to do so? Do they also have to disclose this? Yes. They should discuss any arrangement that may compete with their employer's interest at the time they are hired. So at that time only, they should probably be, see, many of the people are working part-time with the organization. So they might be recommending 10 other products, right? And they might be getting compensation for that, which might be at contradictory to our product. So in that case, they need to inform us in advance. They need to probably, disclose that in advance so that we can probably take a decision of whether it is going to compromise with our service or not. So even if you are doing part-time and if any of your compensation arrangement is going to compete with the employer, that needs to be informed, right? Before hiring. For the firms, we are under additional compensation arrangement. Okay. For the firms, detail of additional compensation, including any performance incentive, should be verified by the offering party. So when the employee tells me that I've got a compensation, additional compensation offer, we need to verify with the party or the client who's offering. Okay. Why? Because if the client is directly reaching out to my employees, right, then even I'm concerned. Clear? Standard 4C, the last of duties towards employers. Here, your role as a supervisor. So under supervisor, there are people working under you. So you have a responsibility not only for yourself, but those working under your supervision, that they comply with the codes and the standards, with the laws and regulations. You cannot say that they did it, not me. No, you are also responsible. It is your job to detect any violations, and you have an obligation to bring an independent compliance system to the attention of the management if there is no. So if there is no such, if there is no such policy at place, you need to uh, put that compliance system, only then take the job. Here it is very crucial, and they have many times asked it. A member or candidate faced with no compliance procedure. What if your firm has no such procedure? Then in that case, see, I am getting the power to become a supervisor, but I'm getting the authority, responsibility, but not the authority. Why? Because there is no compliance procedure. So if there are inadequate procedures or if there is no procedure, then the member must, remember the year, word is must decline the supervisory responsibility in writing until the firm adopts such policy. So yes, if the firm does not have any code of conduct, then you cannot be a supervisor, because there, if the people working under you are not following the company's any compliance procedure or code of conduct, then their violation is your violation. Even if they might not be punished, you are under violation. So you cannot take such a supervision task where the company does not, the firm does not have any adequate procedure at place. You're very important. You must decline such supervisory responsibility. Many students in the past have told me, Kunal, isn't this extreme? Yes, it is, but you need to not take the responsibility unless your firm does have this compliance at place. So you should give it in writing that I'm denying it unless the firm has it place. Otherwise, if you're taking it, you are also in violation. If there is a violation, respond promptly and conduct a thorough investigation, and whosoever has done violation, put restriction on them from further doing any more activities. So put limitation on their job, right? For the members should recommend that their employer adopt code of conduct and ethics, and should encourage their employers to provide that to the clients as well. This is what is recommended. Now here, under this case, responsibility of supervisors, very interesting thing. Once the compliance program is instituted, so first, if there is no such compliance program, you encourage your firm to have such. And once it is at place, it is the duty of the supervisor to distribute that to everyone, update it regularly, and continuously educate everyone. This is the job of the supervisor. Issue reminders again and again to all to be in compliance, and require professional conduct evaluation. So many companies have this at a regular interval to check whether their employees are in violation or not. Review employee actions to monitor compliance and identifying violations, because if they do violation, you are also responsible. For the firms, employers should not commingle compliance. See, compliance is compulsory by the law. So compliance and code of ethics can be different and they should be different. Otherwise, employees will get confused. So you should not try to mix one. You should not commingle compliance procedure with the firm's code of ethics. Otherwise, it will dilute the goal of, see, ethics is one step ahead of compliance and law. So you should not mix up both, right? And when you're investigating a breach of compliance by someone, I told you, you should limit the suspect's what? Activities. You should not let the suspect work unless this comes out clean. Additional compliance procedure in this, I want to highlight one thing. Of course, having a written policy is fine. It is recommended and very important, but designate a compliance officer who has clear authority and power as to what is basically a violation. So having a compliance officer is something that the firm is recommended, right? Have a system of checks and balances, outline the scope of procedure and conduct, what is permitted, what is not permitted. Contain procedures for reporting violation and sanction. So if you come across any violation, where should you report it and what is the punishment for it? And structure incentives such that they don't encourage unethical behavior, right? So unethical behavior is not rewarded. Such should be the structure. This is under duties to employer. Duties to employer, that is standard 4A, loyalty. B, duties to employers, under that standard 4B, you have additional compensation arrangement, and standard 4C is responsibilities of supervisors. Supervisors. Okay. Here, there are some questions which are related to what we've done. So I will just highlight a couple of them. Rest, of course, in ethics, as many questions as you do is, not limited. You can do as many as you want, because the more the questions you do, the better it is. See, some of the questions I will take based on what we've done till now. Which one of the following least accurately describes the CFA Institute standard about using material non-public? Material non-public is integrity of capital market standard 2A. Okay. You have to find which is least likely. An analyst may violate this standard by passing information to others when it has been obtained from outside. Yes. Correct. That's a clear violation. Analyst may use non-material, non-public information, correct, as long it has been developed under mosaic theory, nothing wrong. Analyst using material, non-public information may be fined by the CFA Institute. CFA Institute does not put any fine, right? So this is wrong, correct? Second, Jane Donson, an analyst at a New York brokerage firm, suspects that Bob, another analyst at the same firm, has violated a state securities law. Law is related to which standard? Standard 1A. 1A, professionalism. Under professionalism, knowledge of law. Correct? So this guy has come across suspects that one has violated the law. Suspects, okay, not sure. According to CFA Institute standards of PC, professional conduct, Dawson is not required to report the violation to appropriate governmental or regulatory organization, isn't it? Is he required to do so? No, this is correct. Let's see why B and C are wrong. Required to report the suspected violation to the CFA Institute. No, required to report the violation to the state regulatory. None of them say required. It's not required. The word required is not correct. Clear? Understood? Let's see if we can do 3 also. Pamela is a portfolio manager. She's planning to establish her own money management firm. She has already informed her employer, Branford, about her plans in her remaining time. So she's moving away from the firm. This is about duties to employer loyalty. Under that loyalty, while leaving the organization, what should she do? She should inform her current clients about her resignation and let them know to reach her. Was that a requirement that she should inform her clients? Was there a requirement? No. Solicit Branford colleagues, but not Branford clients. See, Bradford is current employer. Can I solicit the colleagues? Can I solicit the colleagues? No, you cannot solicit unless you have exited. Not only clients, but not even employers. Now, see, many might say that, not even employees. Many might say that employees was not written there. But see, you should not do any act which is going to be harmful to your employer. Understood? So actually, they did mention about colleagues, but still, you should not start the registration of the company. Remember, I told you that can I apply for the license or registration before I leave? Yes, you can. Understood? We can do this. Clear? Got it? Yes. There is one more, I think we can do it. The fifth one, we haven't yet reached that point. Nicole is an analyst at Chicago. She attends a meeting with management of one of the companies that she covers. Okay. During the meeting, management expresses great optimism about the company's recent acquisition of a new business. Fine. Wise is excited about this prospects and issues a research report that states that the company is about to achieve significant success with the new acquisition. Now, what is wrong with this statement? Before even I read the choice. During the meeting, management expresses great optimism. Okay. So management has not management has basically done what? They have shown some great interest. Wise is excited about these prospects and issues a research report that states that the company is about to achieve significant success with this new information. Now, what is wrong with this? Is there anything wrong? Is she correct when she's presenting that information? First of all, do you think there is a violation? Yes, there is a violation. What is that violation? Wise has not violated CFA standard because she had reasonable reason to believe. No, she didn't have reasonable. She was acting on her expectations, not a clear information. Violated the standard, yes. B and C, let's see which one. Of professional conduct, because she did not check the accuracy of the statement that the management made. That is possible. Violated the standard because she misrepresented the optimism by turning it into certainty. See, between B and C, there is a tough fight. Which one? See, did the management actually say we will do it? Did the management say? During the meeting, the management expresses a great optimism about the company's recent acquisition, right? Wise is excited about these prospects and issues a research report that states that the company is about to achieve significant success with the new acquisition. Nowhere the management said so, right? So it's a clear misrepresentation. So the answer is C. Between B and C, C is more accurate. Why? Because it's a clear misrepresentation. Now, see, there is also another standard which we will see, which is about communication with clients and prospective clients, where we have to tell the client what is fact and what is opinion, right? In this case also, so we need to distinguish to the client what is fact and opinion, right? When we are not doing it, we are misrepresenting. So she has clearly violated here, right, by being enthusiastic about what? About something that she believes, but again, that is not correct information. So it's a misrepresentation because the management there did not anytime say that we are planning to do this mergers and acquisition. They have not mentioned it. We added it. So again, it's a misrepresentation. Now see, based on the choices that we have here, right? Based on the choices B and C, violates the standard because she did not check the accuracy of the statement that management has made. Management did not even mention anything about this new acquisition. They did not see, again, management not mentioning is correct. Management, I not checking it. First of all, management didn't even inform anything as what she's presenting, right? So that's a clear misrepresentation. Again, very thin difference here, okay, between B and C, right? But C has more accurate words about where her intuition, she's confirming to the clients that companies about to do such change where there is no such mention. So she's actually giving wrong information. That's why it's a violation. Understood, everyone? The next one is related to the standard that we are going to do later on. Okay. So we've done the 4 standards: professionalism, right? Then we have integrity of capital markets, duties towards clients, and duties to employers, right? Now we will go to investment analysis, recommendation, action, then conflict of interest, and then something that is very interesting to all the candidates, right? Let's see this. So investment analysis, recommendation, and action, under this, it is all about how you should conduct the research, right? So under this, there are three substandards. First, diligence and reasonable basis means whatever we recommend to our clients, that should be carefully done research. So there should be a thorough process of research, and we should have enough research, investigation related documentation. We should have a proper model behind which we recommend the investments, right? So investment analysis should be done in a systematic manner, and that should be, documented. You should have a proper procedure at place. The level of research needed to satisfy will differ from product services, or different types of services that you offer. But there are some minimum things that you need to do, or you need to have when you make recommendations. What? So a list of things that should be considered prior to making a recommendation or taking investment action should be global and national economic conditions. So you should take a macro approach. You should do proper research. You should take these conditions, these things at least before you do a recommendation. Firm's financial result, very much minimum that you should do. Fees and historical results of for a mutual funds. When you're recommending mutual funds, you should not only focus on returns. Apart from returns, you should also look at the fees. Limitations of any quantitative models. Quantitative models are not perfect, so you should analyze them before recommending. Determination of whether peer group comparison for valuation are appropriate. These are the bare minimum steps that you should do when you recommend any investments. Recommendations for, and by the way, there are unlimited. These are some of the vital ones. Recommendation for members. Members should encourage their firm to have a proper policy at place, and that should be periodically reviewed, especially when you are taking information from a third party. So when you're taking third party research, that needs to be properly reviewed. Okay. You cannot blindly rely on them. Examples of criteria to use judging quality are: review the assumptions that are being used by them, determine how rigorous the analysis was. This is basically when you take research from others. Identify how timely the research is, evaluate the objectivity and independence of the recommendation, right? And adopt a set of standards that provide for criteria for evaluating external advisors. So when you have hired external advisors, you should have a policy to, basically check on their quality. You cannot blindly just rely that we have advisors, so it's their responsibility, right? You need to take a review of the external advisors. So overall, this is my standard 5A: diligence and reasonable basis. This is what you need to do when you're recommending investment analysis, when you're doing investment analysis, right? 5B is communication with clients and prospective clients, and this is going to talk all about facts and opinions. So members and candidates must disclose to clients and prospective clients the basic format and general principles of investment process. So how we select the securities that need to be disclosed to the clients. Okay. Disclose to the clients or prospective clients significant limitation and risk also associated with the process. Correct? Here you have to use a reasonable judgment as to which factors are important. You don't have to provide each and every detail. You have to provide them with the basic information. Most important here is distinguish between fact and opinion. When you're communicating with clients, our standard is communication, right? So when you're communicating, you need to tell the client that this is our expectation. It is our opinion, not a fact. This people make mistakes when they rely on statistical models. They sometimes say that our model is saying this, but they need to also say that this is not a fact. This is their model's expectation, which might be an opinion, right? It's not something that is 100% sure. All means and types of communication with the clients, whether it's a formal, informal, whatever communication comes under this roof, okay? Including verbal or written communication. Members must communicate significant changes in the risk. They should communicate upfront. If there is any, because of market conditions, the portfolios have become risky. And when you're using projections using quantitative models, you should inform the client that the models are not perfect. And if there are any limitations in the models, limitations in the assumptions, there is a expected change in the assumption, all that need to be communicated to the clients. This is standard 5C communication, 5A communication with clients and prospective clients. Now we under 5C record retention. So whatever research reports you make, okay, based on that, you conclude a recommendation whether to buy or sell. All of these documents you need to maintain with yourself, right? So members must maintain research records so that tomorrow if the client asks or if you have to go back, you have all this information with you. So all the investment action or research report that you publish, you should have the record about all of them. Also, all communication with clients through any medium should be recorded, and a member who changes the firm, they should recreate this record. They should not take away because it's firm's property, right? So the analysis member who changes firms must recreate the analysis documentation supporting her recommendation using publicly available information. That means, suppose I'm recommending a stock, now I'm changing a firm, I'm recommending another stock. So I cannot, or even if I'm recommending the same stock, I need to recreate the documentation, recreate the records of my research reports and everything. I cannot take it from the previous form, correct? For the members, very, very important, if no regulatory standards or firms policy are in place, standard recommends a 7-year minimum holding period. Remember, this is second one. The first one was about itemized statements to the clients. That should be at least quarterly. This is minimum. If the firm doesn't have a policy, for how long you should maintain the records with you? At least 7 years, correct? This record keeping requirement generally is the firm's responsibility, not your. The firm has to maintain the record for the of all this research. You have to submit it to the firm has to maintain. Everyone clear with this? This has a very, very high chance of being asked. Okay. There are 4 or 5 places where you have these numbers. So this is what we did. Standard 5. 5 is investment analysis, recommendation, and action. 5A was diligence and reasonable basis. 5B was about communication with client and prospective clients, and 5C is about record retention. Now we go to standard 6. Again, standard 6 also has 3 substandard. This is majorly about conflict of interest. Now it has very similarity related to independence and objectivity. So here you will see under disclosure, you should make all full and fair disclosure of any service or any condition which might compromise your independence and objectivity. Such disclosures are prominent and must be done in a plain language. So this can be disclosed to the clients or it can be disclosed to the employer. Anyone who's going to be affected should be disclosed. Examples of disclosure can be broker, dealer, market making activities. So you're not only a broker, you're also a dealer. So you have an activity where market making means what? I told you, the specialist, where we are creating liquidity. That needs to be told to the client that we have hired dealer who are specialists who are going to create liquidity. Board services. So I am, on the board of the particular stock that I'm recommending, I need to disclose because it's a conflict of interest. I have a ownership in that stock. I have to disclose it to my clients. Members' compensation and bonus structure. What is it based on? Is it based on a situation that might conflict with me while I'm recommending that stock? Am I going to get some benefit of that? All that needs to be disclosed. For the members must give their employees enough information to judge the impact of conflict. So I need to inform my client, my employer also, if I am under any conflict of interest, right? So that the employer can take a call whether to avoid that conflict and do what. Need to report them promptly if they occur. Any special compensation arrangements like bonus program, commissions, or incentives, all should be disclosed because they can result in conflict of interest. I might be biased. So all of this needs to be communicated. So first, under conflict of interest, number 1 is disclose it to the employer, clients, or prospective clients. 5th B is priority of transaction. Whose transaction should I have a priority? Always remember, client comes first, then comes employers, and then comes your personal interest, right? So investment transaction for clients and employers must have a priority. Personal transactions may be undertaken only after clients and members have given sufficient, you have given sufficient opportunity to, execute their contracts, right? Note that family members' accounts, right? They cannot be put behind. They have to be treated same like other clients. So family members' account that are client accounts should be treated just like any other account. They should not be disadvantaged. Okay. Very interesting. Members must not act on information about pending trades. Yes. Because you're working for a mutual fund, you are going to do a big bulk order, that is block deal you're going to do. Because of that, there will be a market impact. And hence, you should not do front running. Front running means you should not buy in your personal account before doing it for the company. That is not only unethical, but also illegal. Front running. Okay. When requested, members must fully disclose to investors the firm's personal trading policy. In fact, many of my friends who work in the banks, they are not allowed to do trading. My very close relative who works in a sales of a bank, they are not allowed to do any equity trading. Of course, every company will have their own policy. Okay. By the way, what are we doing? Priority of transactions. For the members can avoid the conflict by not participating in the IPO. Very common, right? They should encourage their firms to have a procedure as to what should be the priority, how should the recommendation flow, right? So procedures listed in the following recommendation for firms if they have not done so. So regarding the priority of transaction, every firms should have a policy if possible. For the firms should have basic procedure as we just discussed to address the conflicts, establish limitation on employee participation, that is very common, restrictions on participation not only in IPO but also in private placement, and put a blackout or restriction period so that people cannot transact in something that we have very important information, or even something that that can probably lead to people taking personal position, employees taking personal position before client. That has to be restricted. So this is my fifth B, priority of transaction. Fifth C is referral fees. So here the candidates and members must disclose their employer, clients, and all prospective clients also any amount or compensation that I'm getting to refer clients, right? So anything that I'm referring to the clients, or any service, product or service that I'm referring for, that if I'm getting any benefit from a third party or an employer or anyone for recommending the product or services, that needs to be disclosed. Okay. For example, you are working in an investment consulting and you are recommending a stock, and for that, or an insurance policy for which you're getting a referral fee, that needs to be informed to the client, so that client and even employers, so that they can take a full cost, evaluate the full cost of the service. Understood? And here, when I mean by consideration, it can be in any form, cash, non-cash, any form. Recommendation members should encourage their firms to adopt clear policies regarding compensation for referrals, right? And members should provide to their employers details about the referrals at least quarterly. Yes. See this. Members should provide their employers with an update at least quarterly to their employers. This is what I call my Y3. So see, Y1, I mean, this is my just initial. You can put your initial 1, 2, 3. First was itemized statement to the clients at least quarterly. Second, members should provide details about the referrals to their employers, update it at least quarterly. Record retention, if nothing mentioned, at least for how many years? 7 years. Clear? These 3 points till this point, right? For sure, 7 years part is very highly, no, I cannot say for sure, but there's a very high chance. So I also recommend you to do that. For the firms, the recommendation is do not prohibit referral fees. Firms that do not prohibit referral fees have a clear procedure for approval. So many firms accept referral fees. You can have referral fees, but there needs to be procedure because it should not compromise the service. Policies regarding the nature and the value of the referral compensation. Referral compensation is very common, but for that referral, there should be a proper policy, especially about disclosure. Clear? So this is standard 6, conflict of interest. Number 1, 6A, disclosure of the conflict. Second, priority. 6B, priority of transaction. And 6C is referral fees. Okay. Based on this, I think there was a question. Let's do that question. Question number, I think 5 was somehow related to that, compensation arrangement or something related to that, right? Let's do this question number 5, everyone. Connie Baker is an analyst with brokerage and investment banking firm Hill and Stevens. Baker's supervisor, John Lewis, has asked her to write a research report on job, whatever it is. The mergers and acquisition department has represented this guy in all of its acquisition for the past 12 years. Both Hill and Stevens sit on the board also. They sit on the board also. First of all, what do you notice? Is there a conflict of interest or not? Conflict of interest. 6A. Is there a conflict of interest? You are sitting on the board of something that you are recommending. So you should disclose it. Yes or no? Yes. According to standards, can Baker write the report? First of all, no. Did they say never do such things? No, they never said don't do it. They said yes, if she discloses. B and C both are yes. If she discloses the directorship and mergers and acquisition relationship, true. If she maintains her independence, see, maintaining independence is fine, but there is a vital information that needs to be disclosed. So between B and C, B is more correct. So see, in ethics, I told you the strategy is different. Here in ethics, C might not be wrong, but B is more accurate, so I choose it. In all other topics, the strategy is different. In ethics, the strategy is different. In ethics, C might not be wrong, but B is more accurate. It has more keywords that I need. So then I will choose for B. This is very different from all other topics, this strategy. Understood, everyone? Clear? Now, the last standard, 7A and 7B. 7A is very much related to you when you go for the exam. So 7A means that you should not engage in any misconduct with regards to your CFA program or even CFA designation. This standard relates to cheating during the exams, revealing any information about what came in exam or any topics tested after the exam. Don't reveal that to me, what formula was asked and all, okay, officially. Not allowing rules and policies of the CFA program, not following any rules during the exam. The proctor might punish you or they might, debar you from the exam. Giving any confidential information about the program publicly or on social media, don't do that, right? Improperly using the designation for personal and professional gains. Many people write CFA designation even when they don't have it. That is also violation. Misrepresenting information about the PCS. So every year, annually, when we write as CFA members, the information, they ask us to fill up all the information. If you are misrepresenting, that is also violation of 7A, conduct as a participant in the program. For the members, it is recommended not to preclude any of, members are not stopped from expressing any opinion. They can express the opinion, but they must not reveal any confidential information. That's the thing. Those who are volunteer in the CFA program as an exam supervisor, they should not solicit or reveal information about the questions and pass it on to anyone, right? Or they should not disclose to anyone what is the grading process, how the questions are scored. All of these are, again, material non-public information, but your confidential information, that is a violation. You should not be doing it. 7B is about reference to CFA. When you're talking about CFA, right? When you're referring about your membership, so referring to CFA institute membership, designation, or candidacy. Here you should not, you should remember, you should not exaggerate your CFA stuff, right? Members must not misrepresent or exaggerate the meaning of CFA. You cannot say someone that I am going to be the best fund manager because I'm CFA. No, you cannot make such promises about guarantees tied to CFA. Also, there is no partial CFA designation. You cannot say someone that I'm CFA level 1 pass. You can say it, sorry, but you cannot say that CFA level 1 is my degree or my qualification. No, you can only say that you have passed CFA level 1, you have passed CFA level 2, but you cannot say that is my qualification unless you pass all the 3 levels and become the member, right? It is acceptable to state that the candidate successfully completed the program in 3 years. That is fine. But you cannot claim superior ability because of that. That is not allowed. Okay. Members must satisfy these requirements to maintain membership. This is your Y4 and Y5. Okay. I mean, your initials. Sign the professional conduct statement. This I have to do annually and pay the CFA Institute membership fee also annually. If we fail to do so, we cannot have active membership. I cannot write my name with CFA. So my name has to be Kunal Doshi, comma CFA or comma Chartered Financial Analyst. There should not be full stop. There should be comma after my name. CFA designation should be after the name, not before, right? Also, it is recommended that those who are going to use my name, they also write it correctly. They should make sure their forms write their name correctly, put their designation correctly. Okay. This is 7A and 7B. Very, very vital. Correct? Now we'll talk about GIPS. We've already talked about the composite, right? First of all, GIPS is CFA Institute, standard with respect to performance presentation. These are set of ethical principles on a standardized industry-wise approach. See, there was no common approach of performance presentation. So CFA Institute came up with GIPS. Now GIPS is only and only for investment firms. Only they can claim compliance, and this is also voluntary. It is not compulsory, right? These standards seek to avoid misrepresentation. That's why they are formed. They are applied to investment management firms only. It cannot be applied to anyone else, right? They allow clients to more easily compare the performance, and it's sort of a self-regulation, because if we follow standard procedure, we will not misrepresent, correct? Some of the characteristics of GIPS: to claim compliance, investment management firm must define what the firm is, and they should be in the business of investment management. After this, I've put up these conditions. Okay. These conditions no more exists in your notes. So this you can avoid reading it. However, just for your reference, I have put it here. It should include actual fee paying discretionary portfolios. Now this is there, correct? But for a minimum of 5 years or since firm on a composite basis, and then continue it till you reach 10 years. So you should present the last 5-year performance and continue doing so for the next 5 years. Then you can get a compliance on GIPS. Now this condition of past 5 years and the future further 5 years to get total of 10 years of compliance, that is no more mentioned in your CFA Institute notes. But my recommendation, there's no harm if you understand it. Otherwise, you can skip it. But remember one thing, that we are going to take only actual fee paying discretionary portfolios. Only they are the part of composite, right? Some students ask me that what about a firm who does not have a 5-year history? Can it not apply? Yes, it can apply, but then they have to continue doing so for 10 years. After that, you will get rewarded. Understood? So yes, in the CFA Institute note, it is not mentioned, but you can just remember it here for your reference. Again, I'll repeat that if you have a 5-year history, past 5 years, then apply, then continue for further 5 years. Then you might get, after the 10-year minimum performance is required for you to get the certification, right? If your history is, let's say, 2 years only, then you apply and then you complete the 8 years. So the total 10 years history is what you can show, and then that total 10-year history, after presenting that in compliance with GIPS, then you might get a GIPS certification. I'm still saying again that I didn't see this in the CFA Institute notes, but I still feel it should be there because it is there under their bylaws. So if this is very controversial, should I do or not do? In the CFA Institute notes, I didn't see this, but my suggestion is, if you read it, it's no harm. Just remember that you need to have a 10-year history of compliance to get the GIPS compliance. Okay. Firms are required to use certain calculation and presentation. Remember, time weighted, money weighted, those things are essential. Input data should be accurate, not estimated. GIPS contains both required and recommended procedures are there already. Those which are required are compulsory. Those which are recommended are encouraged to adopt them, to make them required. Firms are encouraged to present all information, no partial compliance. It should be on a full firm basis. You cannot say that half of my company is compliance. You have to be in fully compliance. But while doing so, if it contradicts with the local law, right? If there is any conflict of GIPS with the local law, it is recommended you follow the local law, right? But disclose whatever the conflict is, right? And there are many which are required, many conditions which are recommendations. They are saying those which are recommendation might become requirement in the future. Here, I have put this 8 sections of GIPS standards. This 8 sections, it's not there in your notes. I just added it. It's, by the way, in your, CFA Institute notes also. Now, these 8 standards, do I need to memorize them? Unfortunately, if they ask one question also, you need to know some information like fundamentals of compliance, input data and calculation methodology. They talk about this. Then you will see composite and pooled fund maintenance, time weighted, money weighted rate of return of the composite. Both are required. You know, time weighted and money weighted both are essential because money weighted is sensitive to manager discretion. Time weighted is not. Both are required. Pooled fund time weighted return, pooled fund money weighted return. So if you see, these 4 are quite common: composite and pooled fund time weighted and money weighted performance. GIPS advertising guidelines. All of these are 8 standards under GIPS. I would recommend you to just know them, read it once. Okay. I'm not expecting you to memorize it right away. Now, the most important that I think that they might ask in exam is about the verification. First of all, tell me one thing: is GIPS required or not required? If they use the word, is GIPS required or not required? First of all, it is not. It is voluntary. Okay. Remember, to do GIPS is voluntary. So firms are encouraged to pursue all independent verification. Now, see, very important thing. GIPS is voluntary. Yes. GIPS is presenting your performance. Do I need to verify this performance? No, even that is not compulsory. Neither is GIPS compulsory, nor is the verification of the performance, even that is not compulsory. Both are voluntary. However, if you decide, both are voluntary. If you decide to do the verification, it has to be done from the independent third party. You cannot self-verify. So verification, 2 conditions. If you decide to do verify, then it has to be done independent, number one thing, and it should be on the entire firm. You cannot select a particular composite and just claim GIPS on it. So number one, is GIPS compulsory? No, it is voluntary. Is the verification compulsory? No, even that is voluntary. But if you do so, you have to compulsorily do independently from someone else, right? And it should be on the firm-wide basis. So if decided to do the verification, it should be done by independent third party only. Is this clear? And then the third party will probably give a certification that the firm, not a composite, the entire firm has complied with the GIPS requirement. Clear? Is this clear, everyone? Right? I've shortlisted some questions on GIPS. I'll conduct that so that you can get an idea. See, this investment management company promotes itself as a fixed investment management firm. The vast majority of its discretionary portfolio it manages are fixed income. Okay. McGraw does, however, manage few portfolios utilizing a growth equity investment strategy. No problem. Different strategy, no problem. But the firm has no intention of ever promoting this strategy. Fine. Under the GIPS, must this portfolios be included? See, all the fee paying discretionary portfolios should be included. Fee paying discretionary. These both are discretionary. They both are fee paying. They just said that they are 2 different strategy. So should I include that in my composite? Yes, I can include it. No problem. Yes, because the portfolios are managed to widely recognized investment strategy. Yes, because the portfolios are discretionary. Now, see, I told you the similarity A might not be wrong, but B is more correct. We are going to accept which portfolios? All fee paying discretionary. So if you get a word fee paying or discretionary, that is the answer, right? No, because the firm does not normally manage portfolios to a growth. No, 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 that is nothing. See, all the fee paying discretionary. Discretionary means, I've got a question. What is discretionary? Discretionary means the fund manager has full control on the decision. That is called discretionary. Okay. Non-discretionary are where the client can also have a decision making control. So then I cannot claim the whole performance is mine. As a fund manager, I need the composite. Under the composite, I will select only those funds which are exclusively my decision. That is discretionary. Understood the difference between discretionary and non-discretionary? Clear? Right? Which of the following is least likely one of the 8 selections of the GIPS? See, again, this you might not memorize it. 8. These are the 8 standards. Fundamentals of compliance, input data and calculation. This is something critical to remember. Rest all are related to composites and pooled. Composite and pooled data, time weighted, money weighted, time weighted, money weighted, and the last is advertising. So which one is least likely? Input data and calculation methodology was there. Pooled fund money weighted was there. Even time weighted was that. Implementation and verification is not one of the sections. Correct. Next, with regard to GIPS, if the CIO of an investment advisory firm is a CFA chartered holder, so the chartered holder is required to comply with the GIPS. GIPS is to be done by whom? GIPS is to be done by a firm. Okay. Neither the firm nor the chartered holder are required to comply. The firm is required. First of all, what is the problem in all of this? The word required, required, required. GIPS itself is not required. GIPS is voluntary. So it is not compulsory for anyone. So the problem is with the word required. So neither the firm nor the chartered holders are required to comply with GIPS. Understood? Clear? The problem is with the word required. Requirement is GIPS is voluntary. Okay. And voluntary for whom? The firm. GIPS is voluntary and voluntary for the firm. Individuals do not get GIPS certificate. Okay. It's only for the investment management firm. Which of the following statement about GIPS compliant firms verification of GIPS compliance is most accurate? This is very, very important. In GIPS, there will be a couple of questions. Mostly they will be about verification and all. Okay. Is verification optional, but if chosen, must be performed by independent? Is verification required? No, not required. But if done, it has to be done from independent third party. A is the answer. Everyone clear? Last, the section of GIPS that outlines defining the firm and documenting firm's policies and procedure. So see, this is actually very complicated. Firm's policy and procedure, that is part of fundamentals of compliance. Of course, you don't have time and you don't have to go into the detail of fundamentals and read it. But see the rest, composite, pooled fund maintenance, advertising, it is nothing related to that. Now, again, these are based on intuition. When you read it, you'll get it. I don't see some of these questions coming up in the sense that even if they come up, it's very complicated about to go in detail of all of this 8 sections. You can't go in detail of them. You just need to know the name. Okay. So it's okay. 1 or 2 questions, you find it very difficult, but overall GIPS will have 2-3 questions, which will be mostly related to verification or mostly related to composite. Correct. And they will mostly ask whether GIPS is voluntary, whether verification is voluntary, should it be done by self or independent, more similar to that. Clear? Well, that's the end of ethics. Yes, ethics closes here. But in reality, ethics reading should be only 20%. More of the ethics is based on how many questions and how many variety of questions you do. Ethics is not something that, see, the reading that I did in this couple of hours will not be enough for you. I'm just highlighting on the point. Many of the things you might have seen that I'm just repeating it because it's just understandable, but keywords are this. So this 10-12 pages, I would recommend if you don't want to read the whole of the book, you can just read this couple of pages. It covers all the keywords. Okay. especially those Y1, Y2, Y3, Y4, Y5, I said where there is, I've highlighted in blue. So the keywords I've bolded, just read that. Just read once or twice ethics, whatever I've written, that is more than enough. And then directly go on hitting the questions as much as you can. In all other topics, in all other topics, 50% reading, 50% solving the question, or you can say 30% reading, 70% solving the questions. In ethics, 10% reading and 90% solving the questions. Okay. Now I've got a question. Where do you recommend questions for ethics? See, first of all, as the source that we have been doing, you should be doing that, as well as CFA Institute. CFA Institute, you can do it. Kaplan Schweizer, you can do it. In ethics, I would recommend ethics as much as you can, you should do it, right? The language, you for that, if because in exam you're going to get a similar language, do it from the CFA Institute material, all the ethical questions of the CFA Institute. That is very essential. By the way, you have one more reading called ethics application. That is the last reading. Now that doesn't have any notes, but that is nothing but different cases related to what we've done. So I would recommend you to read that. So that is clear. In that reading, it is clearly mentioned what is violation, what is not a violation. It's a very brief reading of what we did. So that ethics application, quickly scroll. So you'll get step by step what is violation, what is not violation. Also, one more thing here, all these 7 standards and 22 substandards, while you read it, try to make a chart. Oh, this comes here, this comes here. Sometimes they ask you that, is it related to duties to employers or duties to clients? What is it related to? So sometimes you might require, I generally recommend students to understand, memorize, read all the standards and substandards, make a chart. This is under this because this has the highest weightage in your CFA level 1. So why not invest this much time? Clear? Perfect. Okay. All the best. Thank you very much. Bye bye. Take care. Thank you. Thank you. Thank you.